What we know is a drop. What we don't know is the ocean.
Hello, and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. The Newton Knowledge Podcast will provide meaningful content to our valued advisor community. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network.
All right, we should be good. Patrick, how was your fourth? You were traveling, right?
It was good, yeah. I've got a lake home about an hour south of my regular home, so that's where I spend most of the weekends and holidays in the summer. And it was good. Good fireworks, friends, food, enjoying the holiday.
Where is the Ozarks?
Ozarks is about 2.5 hours west of St. Louis or 2.5 hours east of Kansas City. So kind of dead in the middle of Missouri, just a little bit of south of Jeff City, which is the capital.
That's not your lake.
That is not my lake. That is a big, busy lake. I'm actually headed there later this week.
Well, we appreciate you joining us. And I know we turned this around fairly quickly. We wanted to get you in for our July episode, and we try to air these the 15th of every month. So we're coming up on it. So we really do appreciate your time and flexibility and participating so quickly. When you and I spoke, how much Steve and I enjoyed your webinar hosted by Pacific Life. We thought it was great. A lot of the stuff you explained is not that, I would say, easy to understand, and the way you did it was very digestible, especially if you're articulating that to clients. It was just wonderfully done. So we both connected and said we should try and get Patrick on the podcast. So here we are.
Well, I appreciate the kind words.
St. Louis is one of the best cities, I think, to watch sports in.
You know, it is a good sports city. We've got the Cardinals, which have been, competitive for many, many years. We've got the St. Louis Blues, who won the Stanley Cup back in, I guess that was 19. And, we used to have the Rams. We don't have that anymore. Everybody seems to have turned into a Chiefs fan around here now.
City set up with, it's walkable. At least that's how I remember it. Easy to get around. A nice group of people. A little different than our hometown. We're not. Oh, we are recording now.
We are. Wait, no, but we've been recording. You know how it goes.
We're Philadelphians.
Yeah.
We have a little bit of a reputation.
Yeah, I was up there a couple of years ago speaking at it was for a National Jewelers Association.
Really? Does your practice focus on? Was there a reason for that, or was it just kind of
same kind of stuff? Primarily I'm talking usually about business succession planning and estate planning, and similar to the reasons that you guys y'all are interested in talking to me. They want to make sure that their members are well taken care of, and they've got plans for their businesses to transition to, whether it be the next generation of owners or third parties or employees, that they've got plans in place. Because, as soon as you don't have a plan, then you might lose a business and they lose one of their association members and the industry shrinks. So they don't like that.
Yeah, and you're spot on. This is exactly why we wanted to bring you on and talk in greater detail on business succession, estate planning, tax planning. But before we dive into that, can you tell us a little bit about your career path, becoming an estate planning attorney and partner and chair of the private wealth group at Husch Blackwell?
Yeah, I started back here at Husch Blackwell. Gosh, it was probably 2010. So I've been here since then and worked my way up to the place that I'm at now. Before this, I'd worked at 3 other law firms, all of which I was doing the same thing, which is essentially private wealth law, which is working with individuals and closely held business owners for estate planning, business succession planning, tax mitigation, asset protection planning, privacy planning. All those things kind of run together. And been doing it my whole career. Got out of law school back in 2003, so I guess it's been at least 22 years as a practicing attorney now, and always here in St. Louis. I knew I wanted to go into this area of law as soon as I started taking my first tax class in law school. It just made sense to me, and I broadened out into other tax classes, and then learned about the estate tax and got into estate planning, and Really the best part of it is you get to work with individuals and families and help them out. And helping families is really our prime focus here at our firm. That's kind of our mantra for our private wealth group, is making sure that we're helping families. And almost everything we do points back toward that, whether it be, just a family that needs an estate plan, a business owner that needs a succession plan and supports their own family. Not only that, but all of their employees' families as well. So it all kind of relates back to helping out families.
Are there any personal stories or journeys you want to share on as you became a partner of Husch Blackwell?
Moving to Husch Blackwell, one of the things that I really liked about our firm is we're very innovative and we're very entrepreneurial. So the firm has a great platform in that, we're one of the largest firms in the country. We do just about everything in the law, which allows me to better serve the clients that I have in the private wealth group because we can support just about any other legal need they have. But we're interested in going out and, trying new things and different kind of fee structures. And we use a lot of AI in our group now. We're very innovative as a law firm. And I saw that when I was coming here back in 2010, and that's what really brought me to this firm. And just being around some of the other partners here at this group has their mentorship and seeing what they can do has really benefited my practice and grown my practice to the point that it's at now. And gosh, our group has grown from, I don't even know what it was when we started, but we've got about 55 attorneys in our private wealth group, and we continue to grow. The emphasis on helping out families is something that really stands out, and everybody here is concentrated on that and comes in and works hard.
Let's do a deeper dive on the webinar that really caught myself and our managing partner, Steve Target's attention. And let's start with the framework of estate planning. You boil it down into three deceptively simple questions. Where do your assets go? Who is in charge? And what are the rules? So for clients with complex portfolios or intergenerational dynamics, how do you help meaningfully engage those three questions?
When it comes to estate planning, one of the goals is taking complicated things and making them understandable. And you have to relate to people in language they can understand. Oftentimes, attorneys talk in what I call legalese or sophisticated talk that most people don't really understand, and that's not good client service. So, boiling it down to those three simple questions is really the foundation of estate planning. And if we can help people understand those three questions and educate them and get them to an answer to each of those three questions, we can help them design their estate plan in an effective way. And really, when you're working on estate planning, one of the keys is making sure you get your clients educated. Because if you get them educated, they can make the right decisions for them and their family, but they have to know what the options are that are out there. And we can start, I always start extremely simple, and then we can go as deep and complex as they want to go.
I love it. Let's talk about timing. I mean, that's a huge component to this type of planning. The current federal estate tax and the gift exemptions at historic highs. But with the new legislation out, maybe if you want to touch on that a little bit and the importance of that. And then second, it'd be great if you could touch on that window analogy you had within your webinar. I just thought it was great, and talk about taking complex planning techniques and making it into something that's very easily digestible.
Yeah, of course. The tax talk has been really hot lately with the one big beautiful bill being negotiated and potentially passed here shortly, signed into action. The estate tax is something that drives a lot of the higher end estate planning that we do. And the estate tax, to make it simple, is essentially a tax on your net worth on the day you pass away. On the day you pass away, the government takes a snapshot of your net worth, the value of all of your assets, plus the death benefit of any life insurance, less any debts that you have. And they take that net worth number and they compare it to their law. So right now, God forbid any of us die today, we've got a $13.99 million estate tax exemption, meaning if you're under $13.99 million of net worth, no estate tax. But if you're over $13.99 million of net worth, they take 40% of the overage. And that amount is due in cash within 9 months the day you die. So that $13.99 million number has changed a lot over the years. When I first started practicing a long time ago, Back in the year 2000, when I was learning about the estate tax, if you had over $675,000 in net worth, they were going to take 55% of anything over that. So we've come a long way from that. And there can be changes anytime the administration in DC changes. We had two wildly different views of what was going to happen in the most recent election. We ended up where we are today with the one big beautiful bill looking like it's going to be signed into action, which is going to raise that $13.99 million exemption to $15 million and keep it indexed to inflation. And perhaps with some permanency, there's no scheduled sunset like there has been in the past. But again, the law is only as good as the administration that's in office. It can be changed at any time. So, those laws are vitally important to what we do for protecting some of our families and attempting to mitigate those estate taxes. With the use of a properly drafted estate plan for a married couple, you can effectively double those thresholds, right? So instead of 13.99 million, we can protect double that. And soon, instead of 15 million, beginning on January 1st of next year, if this law is signed, we'll be protecting 30 million. And having your core foundational estate planning documents properly drafted helps take advantage of that double exemption for a married couple. And not only that, when we're working on estate planning, we want to make sure that once we've done that planning and we've gotten those assets moved through someone's estate, we want to help make sure that those assets stay outside the estate tax system for future generations. So making sure that we're engaging our proper generation skipping transfer tax planning and using proper downstream trusts in our revocable trusts is really, really important. So that's kind of your foundational level. And then you asked, hey, what about that window analogy? So, that estate tax exemption, I kind of call it a window of opportunity. And if you think about your estate plan, you've got assets that are included in your estate, things that you own or owned in your revocable trust, your living trust, and things that we might want to get out of counting toward your taxable estate. Well, we've got, right now a $13.99 million window that's open that we can pass assets through from inside your estate to outside your estate. And we want to make sure if we're doing that we are taking proper advantage of the things the law allows us to do in order to pass assets through that window from inside the estate to outside the estate. And as we pass assets through, that window shrinks, right? So if we pass $1 million via gift from the inside of the estate to the outside of the estate, that window shrinks from $13.99 million down to $12.99 million. So we always want to make sure we're making an efficient use of the assets that we transfer through that window. When you think about targets for that, it's generally appreciating assets and preferably rapidly appreciating assets that we would look and want to pass through that window.
So with the window being, as we said earlier, the largest it's ever been, how are you advising clients to use it or lose it as that window may be larger than it is now, or if it is reduced, who knows? What are you advising your clients to do with this large window of opportunity to shift assets out of one's estate?
Yeah, well, as we talked about, if the law, like what you didn't talk about, but if the law is not signed, if the one big beautiful bill is not signed by President Trump, at the end of this year, that $13.99 million exemption was supposed to fall and be cut in half to approximately $7 million in change per person. So it's only this new bill that would cause the 13.99 million to increase to 15 million indexed to inflation on January 1st. But of course, as we did talk about, that law could change in the future. And of course, any administration could come in and change the law to a lower exemption. But not only should you be concerned about what the exemption level is for most of our clients, right? Their assets are increasing in value over time. Their investments are going up in value. Inflation is happening. Real estate's going up in value. Their businesses are becoming worth more and earning more. And so for our clients that either have now, an estate tax issue, meaning as a single person, they have over $13.99 million, or as a married couple have over double that, we want to make sure that we're getting their assets we want to engage in estate tax mitigation to get those assets moved out of their estate. And if it's someone that looks like they may have a future problem, we want to make sure to get those assets moved out of their estate before it becomes a problem. And that way, the appreciation that we just talked about, the increase in value, the income, the appreciation is happening outside of their estate rather than inside of their estate, where everything gets taxed at 40 cents on the dollar on the passing. And, when's the right time to do that? The right time to do that is today, because tomorrow the assets are worth more. And so if we can start getting engaged with people right away on making these moves and making an estate tax mitigation plan, it can make a huge difference for several generations into the future with that estate tax mitigation.
Patrick, thanks for all the great work you do on behalf of all of our clients. And our approach has always been that we as an insurance planning firm really like to get engaged after you've done a lot of the heavy lifting. Let's make sure we can move those assets through the window. Let's make sure they're structured in a way that offers generational transition if that's important to the family. And so let's throw out some of the acronyms that we all know very well, but perhaps our audience doesn't. Some will, of course, but there's one that I'd like you to spend a little bit more time on. We all know about ILITs. Slats have become very, very popular as well. Maybe touch on those two briefly. But then the BDITs. That's become something that we're seeing and hearing more frequently now. And there's certainly a place and an opportunity for our clients to structure the BDITs. Can you elaborate on ILITs, slats, and BDITs in a manner that, as you do so well, is a very sophisticated way, but one that we can understand?
Well, of course. And I think you took them down in the correct order there. When we think about doing our estate tax and estate planning for our clients, business succession planning, one of the first things we do is always, again, make sure they have the core foundational estate planning documents in place. So your healthcare power of attorney, your financial durable power of attorney, your will, and your regular revocable or living trust. And so then we start looking, for our clients that have potential estate tax problems. One of the first things we look at is the irrevocable life insurance trust, the ILIT. And that way we're moving either existing life insurance to a place where it doesn't count for estate taxes, the death benefit doesn't count for estate taxes, or we're purchasing new life insurance to mitigate estate taxes, to have liquidity there. One of the big problems we have with our clients is oftentimes they've got a high net worth, but they don't have many liquid assets. They have a closely held business or a farm, other illiquid assets. And so, if an estate tax were to come due, we would have to have a fire sale if not for having life insurance in an ILIT. And some of the other techniques that we'll talk about, the slats and the BDIT, take some time to implement, and the strategies take some time to come to fruition for the estate tax mitigation. So having that liquidity set aside in an ILIT, irrevocable life insurance trust, is a really critical part of the plan in the case there's a passing in the short term, or we don't have liquidity to cover a potential estate tax. So that's kind of step 2 after the core documents. Step 3 for our married individuals, as you mentioned, is slats, spousal lifetime access trusts. One of the things that people like about estate and gift tax planning is saving the money on estate taxes and making sure their assets are going to the right place and we've got the right people in charge. We've got a plan for the future. One of the things people don't like is giving up control over things and giving up beneficial enjoyment over things. Okay? So that sometimes throws a wrench in the best laid plans for the estate planning and estate tax planning. So the slat is a technique generally for a married couple where spouse 1 creates a trust for the benefit of spouse 2 and the family, with spouse 2 in charge. And then spouse 2 creates a trust for spouse 1 and the family, with spouse 1 in charge. And then we have each spouse gift assets or potentially sell assets to those trusts for the benefit of their spouse and descendants. Although those trusts cannot be identical, they have to be different in some fashion and probably in several fashions to not run afoul of the reciprocal trust doctrine. Generally, this puts our married couple back in a place similar to where they started, as long as both spouses are alive, but we've gotten some of their assets moved through that window outside of their estate where it doesn't count for estate taxes, but as long as both spouses are alive and married to one another, they still maintain full control and beneficial enjoyment of those assets. So that helps defeat some of those problem objections that we have to doing some of the estate tax planning at a higher end. So we like the SLAT plan for married couples. And then, of course, you brought up the Beat It, which is the Beneficiary Defective Inheritors Trust. The Beat It has nothing to do with the Michael Jackson song. We have to have a little bit of humor in our estate planning, right? So the Beat It is another strategy that we use for our clients, sometimes for single people and sometimes for people that aren't even comfortable giving up control or beneficial enjoyment to their spouse or descendants. And so the Beat It is a trust that is set up by a third party. I often call it Mom's Trust. We have Mom set it up for us. And that's because Mom always loves us. So she's happy to participate in some estate planning with us. So Mom sets up a trust. She adds somewhere less than $5,000, but usually exactly $5,000 to that trust. And her involvement is done at that point. And that trust is set up for the benefit of our client with our client as trustee. Our client has the right to withdraw that $5,000, but does not. And this causes that trust to be a grantor trust to our client, meaning it is income taxable to our client. The same way the slats are. I didn't talk about that during the slat, but the slats are income taxable to our client. We really like having the irrevocable trusts income taxable to our client, even though that sounds bad initially to our clients. They don't like that initially. After I explain it, they like it much better, because it allows the assets of that trust either A, to accumulate income tax free outside of our estate while lowering our taxable estate by paying the income taxes on behalf of those trusts. I call that the income tax burn. Or if we're doing a sale to our slat or our Beat It, we are paying back money on our promissory note from the trust to our client, and we're using that money to pay the income taxes. So it's a little bit of poetic justice that we are saving money on estate taxes by paying income taxes. So back to that Beat It. We've got Mom that set it up. It's income taxable to our client. It is outside of our client's estate, outside of Mom's estate, but our client still has full control as the trustee and full beneficial enjoyment. So our clients really like that. The rub about the Beat It: you cannot gift anything to it. You can only sell things to it. Okay. The slats, you have the advantage of being able to use gifts and use up your gift and estate tax exemption, transferring assets there too, in addition to the sale. But the Beat It, we cannot gift anything to it. We can only sell things to it. However, you get to maintain the control and beneficial enjoyment yourself.
Can you sell shares of a privately owned company to a Beat It?
Yes. In fact, that's one of our favorite things to do is we go out and we take a look at that company. And oftentimes, if it's a corporation or an LLC, we'll transform that company into a company that has voting interests and non-voting interests. Generally, we have a small percentage that's the voting control and a larger percentage that is the non-voting control. And then we sell or gift those non-voting interests to our irrevocable trust. In the case of the Beat It, we would sell the non-voting interest to that Beat It. And that gives us a couple advantages. Number one, it allows us to separate equity from control in that business. We can maintain the control in our own individual name. That's especially handy if we're using a slat or a family trust, gifts for family members. But it also allows us to take advantage of potential discounting on those non-voting interests because they have no control of the company. They're along for the ride. Those generally carry a discount to fair market value of somewhere between 5 and 40%, depending on the company, the industry, and the way the documents are structured. And that gives us a wise use of either our estate and gift tax exemption or our sale proceeds when we're moving things through that window from the inside to the outside. So things that we love this strategy with is closely held businesses, potentially real estate companies, any sort of other assets that are worth little now but may be worth a lot more later.
Let's keep going down maybe that valuation conversation and talk a little bit about valuations and discounting and maybe tying in family limited partnerships and some recapitalizations. I know there's a lot here to talk about, but let's brush through some of these opportunities to continue to enhance the transition, gifting, selling of assets to the next generation.
Yeah, of course. As we talked about earlier, I try and keep things simple. So my simple example is if I took and put $100 bill on the table in front of you, and then on the other side of the table, I put a $100 gift card to your favorite restaurant, which one would you rather have? You'd rather have the $100 bill because you can use it anywhere. The gift card has restrictions, and therefore the gift card, even though it's for $100 to your favorite restaurant, probably on the open market is not worth $100, whereas the $100 bill is. And that's kind of the way discounting works, right? So you take your entity, whether it be a limited liability company, a corporation, or a partnership, and you separate it into voting control and non-voting control, as I mentioned. It's very popular to either do a 1% voting and a 99% non-voting, or a 5% voting and a 95% non-voting. In just the same way we talked about that gift card, because the non-voting interests have zero control over the direction of the business, because those people are generally along for the ride, and generally because those shares and the transfer of them are very highly restricted, those things on the open market are not going to be worth 100% of the fair market value that their percentage of the company comprises. And so that's how the discounting works. And it, as I mentioned earlier, it also is a benefit of separating equity from control. One of the things that hinders some of our clients is they don't want to give up control over the business that they've controlled for so long, but they do want to engage in the estate tax mitigation. And in a normal business, if you transfer away more than a 50% ownership, you've given up control. Well, with our split of the 1%, 99%, you can give away 99% of the ownership of the business, hold on to that 1% controlling interest, and you still have 100% control of the business. So two really big benefits to either recapitalizing a corporation, having voting and non-voting membership interests in a limited liability company, or perhaps engaging in a family limited partnership that uses that same structure.
And then, although I think this could be a podcast in and of itself, or maybe two podcasts, the qualified small business stock, and I think that's related to Section 1202. There's some pretty extraordinary tax benefits. Can you touch on that a little bit for our audience as well, and just to make them aware of
the 1202 qualified small business stock, often referred to as QSBS, is something that is really becoming a lot more popular lately. And it's something that people don't know a lot about. And I've had some businesses that are going through sales that I've brought this up and made a huge, tremendous difference in their families' lives by saving money on taxes. And essentially what it is, it's a capital gains tax exclusion on the sale of C corporation stock. Okay. So if you have a C corporation, which not a lot of people do, but there are some out there, if you have a C corporation, you can exclude potentially up to 100% of the capital gains tax on the sale of your C corporation stock. There are some requirements for participating in this. And of course, the first one is making sure you have a C corporation. But one of the other ones is you have to be either the original owner of the C corporation stock, or you have to have acquired it as an inheritance or a gift. You can't have purchased it. So that kicks a lot of people out of the QSBS realm. So when we have it, it was kind of originally structured for people starting businesses and getting people to invest in startup businesses that are perhaps in the tech industry, but it's expanded really far out of that.
Patrick, this has been wonderful. I think we would be remiss also. I just want to add here as we're reaching the end of our conversation. We were all introduced by Carol Jensen at Pacific Life. And I just wanted to give a little shout out to Carol and thank her for introducing us and bringing you to our attention. Thank you very much for being with us.
Yes, thank you, Patrick Connor, and thank you, Carol, and the Pacific Life team for coordinating this so quickly. Patrick Connor, partner and chair of Private Wealth Group at Husch Blackwell.
It's my pleasure, guys. Happy to be on here, and thanks for having me out today.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.